Welcome to our comprehensive guide on managerial accounting, where we'll explore three critical areas that drive business success: budgeting, cost analysis, and performance evaluation. Managerial accounting is a vital tool for business leaders, providing the insights needed to make informed decisions, optimize resources, and achieve strategic goals. In this video, we'll delve into the intricacies of creating effective budgets, analyzing costs to improve profitability, and evaluating performance to ensure alignment with organizational objectives. Whether you're a seasoned manager or new to the field, understanding these concepts will equip you with the knowledge to enhance operational efficiency and drive business growth. Let's get started on mastering these essential managerial accounting skills. 1. Budgeting. Budgeting is the process of creating a plan to manage your finances, typically for a specific period, month, quarter, year. In managerial accounting, budgeting helps managers plan and control financial resources to achieve business objectives. Types of budgets. Operating budgets focus on day-to-day operations. Includes sales, production, and administrative expenses. Example: a monthly sales budget and a monthly expense budget. Capital budgets, concerned with long-term investments. Includes expenditures on assets like equipment or buildings. Example: budget for purchasing new machinery. Cash flow budgets track the inflows and outflows of cash. Helps ensure there is enough cash to meet obligations. Example: monthly cash flow projections. Budgeting process. Planning, set goals and objectives. Forecast revenues and expenditures. Prepare detailed budgets for various departments. Forecasting, use historical data and market trends to predict future performance. Adjust forecasts based on changing conditions. Monitoring, compare actual performance with budgeted figures. Investigate variances and take corrective actions if needed. Types of budgets. Fixed versus flexible budgets. Fixed budget remains constant regardless of activity levels. Simple but less adaptable. Flexible budget adjusts for varying levels of activity. Provides a more accurate performance evaluation. Zero-based budgeting, ZBB, starts from zero base each period. Every expense must be justified. Useful for eliminating waste but can be time-consuming. Incremental budgeting, based on previous periods' budgets with incremental adjustments. Easier to prepare but may perpetuate inefficiencies. Budgeting techniques and tools. Rolling budgets, continuously updated, usually quarterly. Helps to stay current with changing conditions. Top-down versus bottom-up budgeting. Top-down, senior management sets budget targets. Bottom-up, budget created by department managers and aggregated. Both approaches have advantages and can be combined. Budget variance analysis identifies and analyzes differences between budgeted and actual performance. Helps in understanding why variances occurred and making adjustments. 2. Cost analysis. Cost analysis helps in understanding the costs of producing goods or services and their impact on profitability. Cost classification. Fixed costs versus variable costs. Fixed costs do not change with the level of production, e.g., rent. Variable costs vary with production volume, e.g., raw materials. Direct costs versus indirect costs. Direct costs can be traced directly to a product or service, e.g., direct labor. Indirect costs cannot be traced directly and are often shared, e.g., utilities. Product costs versus period costs. Product costs associated with production and included in inventory, e.g., direct materials. Period costs expensed in the period incurred, e.g., office salaries. Cost volume profit, CVP, analysis. Break-even analysis determines the sales level at which total revenues equal total costs. Formula: break-even point equals fixed costs selling price minus variable cost per unit. Text: break-even point equals frac text fixed costs text selling price text variable cost per unit. Break-even point equals selling price minus variable cost per unit. Fixed costs. Contribution margin represents the portion of sales revenue that exceeds total variable costs. Formula: contribution margin equals sales minus variable costs. Text: contribution margin equals text sales. Text: variable costs. Contribution margin equals sales minus variable costs. Margin of safety measures the amount by which sales can drop before the business reaches its break-even point. Formula: margin of safety equals actual sales minus break-even sales. Text: margin of safety equals text actual sales. Text: break-even sales. Margin of safety equals actual sales minus break-even sales. Activity-based costing, ABC, concept and benefits allocates overhead costs based on activities that drive costs. Provides more accurate cost information. Implementation steps identify activities and their cost drivers. Assign costs to activities and then to products based on their use of activities. Cost behavior and estimation. Cost behavior patterns. Costs can be fixed, variable, or mixed, semi-variable. Understanding patterns helps in forecasting and budgeting. Cost estimation techniques. High-low method uses the highest and lowest levels of activity to estimate variable and fixed costs. Scatterplots, visual method to analyze cost behavior. Regression analysis, statistical method for more accurate cost estimation. 3. Performance evaluation. Introduction to performance evaluation. Performance evaluation assesses how well an organization or individual meets its objectives, using various metrics and tools. Key performance indicators, KPIs, financial KPIs. Profit margins measures profitability, e.g., gross profit margin, net profit margin. Return on investment, ROI, measures the gain from investments relative to their cost. Non-financial KPIs. Customer satisfaction, metrics like Net Promoter Score, NPS. Employee turnover, measures employee retention. Performance measurement tools. Balanced scorecard provides a comprehensive view by evaluating financial and non-financial aspects. Includes perspectives: financial, customer, internal processes, learning and growth. Benchmarking. Comparing performance against industry standards or best practices. Helps identify areas for improvement and set performance goals. Variance analysis. Analyzing the differences between actual and budgeted performance. Helps in understanding reasons for variances and making informed decisions. Management by objectives, MBO, concept and implementation. Setting specific objectives with measurable outcomes. Aligning individual and organizational goals. Performance reviews. Regularly reviewing progress toward objectives. Adjusting strategies as needed. Performance reports and dashboards. Types of reports. Financial performance reports include income statements, balance sheets. Variance reports show differences between actual and budgeted figures. Effective reporting techniques use visual aids like charts and graphs. Ensure clarity and focus on actionable insights. Recap of key points. Summarize the importance of budgeting, cost analysis, and performance evaluation in managerial accounting. Highlight how these tools aid in planning, controlling, and improving business performance. Importance of managerial accounting. Emphasize its role in strategic decision-making, cost management, and performance enhancement.
The balance sheet is one of the essential financial statements that reflects the financial position of a company at a specific point in time. It is also known as the statement of financial position. This statement consists of three main parts: assets, liabilities, and equity. Assets include everything the company owns, such as cash, inventory, accounts receivable, and property and equipment. Liabilities represent the financial obligations of the company and include loans, accounts payable, and other payables. Equity shows what remains of the assets after deducting liabilities and includes paid-in capital and retained earnings. The purpose of the balance sheet is to provide a clear picture to investors and financial analysts about the sources of funds used in the business and how they are distributed between assets and liabilities. This statement offers a comprehensive view of the company's ability to meet its debts and achieve future growth. Understanding the difference between a budget and a financial statement is crucial for both individuals and businesses. The terms are often used interchangeably, but they represent distinct financial tools with different purposes and functions, although they are related. A budget is a financial plan for future income and expenses over a specific period, often a year. It is a forecast that helps individuals or organizations allocate resources, plan for future needs, and control spending. Budgets are dynamic and can be adjusted during the period based on actual income and expenses. They provide a framework for financial discipline and decision-making. On the other hand, a financial statement, also known as a balance sheet, is a historical document that summarizes the financial position of an individual or organization at a specific point in time. It consists of three main components: assets, liabilities, and equity. The financial statement provides a snapshot of what is owned and owed and the net worth. It is used to evaluate financial health, manage debts, and analyze the performance over a period. While the budget is forward-looking and predictive, the financial statement is backward-looking and reflective. Together, they offer a comprehensive view of financial planning and performance. In the financial statements of businesses, the balance sheet, or statement of financial position, is a fundamental tool that reflects the financial condition of the company at a specific point in time. However, not all accounts appear on this statement. Some accounts that do not appear on the balance sheet include expense and sales accounts, as these are shown in the income statement. Additionally, profit and loss accounts have no place on the balance sheet because they are integrated into equity and reserves. Temporary accounts such as revenues, expenses, and other transactions related to the short-term financial period are part of cash flows or the income statement, not the balance sheet. These other statements help complete the overall picture of the company's financial situation. Financial statements, particularly the balance sheet, can be evaluated based on various key indicators to determine if they are strong or weak. A strong balance sheet often features a high level of assets compared to liabilities, implying good liquidity and financial stability. Key components that contribute to a strong balance sheet include a high current ratio, current assets divided by current liabilities, low debt-to-equity ratio, total liabilities divided by shareholders' equity, and consistent profitability and revenue growth. Additionally, having substantial cash reserves and diversified assets can also be indicators of a strong balance sheet. Conversely, a weak balance sheet may display a high level of liabilities in comparison to assets, indicating potential liquidity issues and financial instability. Key signs of a weak balance sheet include a low current ratio, high debt-to-equity ratio, and inconsistent or declining profits and revenues. Limited cash reserves and heavy reliance on debt financing can exacerbate these weaknesses. In summary, the strength of a balance sheet can be quantitatively assessed through financial ratios and qualitative aspects such as asset diversification and liquidity management. Besides the ratios, the industry context also matters. For instance, a tech company may have different standards for what constitutes a strong balance sheet compared to a manufacturing firm, due to the different nature of assets and liabilities inherent to those industries. Therefore, while financial metrics provide a snapshot, industry norms and context are also vital for a complete assessment.
In accounting, inventory refers to the goods and materials that a business holds for the purpose of resale or production. It is considered a current asset on a company's balance sheet, as it is expected to be sold within a year. Inventory typically includes raw materials, Items used in the production of goods, for example, wood for furniture. Work in progress, WIP. Partially finished goods that are still in production. Finished goods. Products that are ready for sale. Key concepts in inventory accounting. Inventory valuation methods. FIFO, first in, first out. Assumes the first items purchased are the first ones sold. LIFO, last in, first out. Assumes the last items purchased are the first ones sold. Weighted average. Averages the cost of inventory items. Specific identification. Used when the cost of each specific item is known, for example, unique or large items. Inventory turnover ratio. Measures how quickly a company sells its inventory. Calculated as inventory turnover equals cost of goods sold, COGS, / average inventory. Inventory management. Involves ensuring the right amount of stock is available to meet customer demand while minimizing holding costs. Accounting for inventory. Initial recording. Inventory is recorded at cost, which includes the purchase price, shipping, and handling fees. Cost of goods sold, COGS. When inventory is sold, its cost is transferred from the balance sheet to the income statement as COGS. Let's dive deeper into key areas of inventory accounting, including valuation methods, inventory management, financial reporting, and metrics. Inventory valuation methods determine how the cost of inventory is assigned to the cost of goods sold, COGS, and the remaining inventory. FIFO, first in, first out. Method assumes the first inventory purchased is the first to be sold. Impact. In periods of rising prices, FIFO results in lower COGS and higher inventory values on the balance sheet, which increases net income. B. LIFO, last in, first out. Method assumes the most recently purchased inventory is sold first. Impact. In periods of rising prices, LIFO results in higher COGS, lower ending inventory, and reduced taxable income. Example: if the same company uses LIFO, it assumes the $6 units are sold before the $5 units. C. Weighted average cost. Method calculates an average cost for all inventory items available for sale. Impact: the cost of inventory and COGS is smoothed out over time, providing a middle ground between FIFO and LIFO. Formula: weighted average cost equals total cost of goods available for sale divided by total units available for sale. Example: if a company has 200 units costing $1,100 total, the weighted average cost is $5.50 per unit. D. Specific identification. Method tracks the actual cost of each individual item sold. Usage used for expensive or unique items, such as cars or jewelry, where each item has a distinct cost. 2. Inventory management. Effective inventory management is crucial for controlling costs, meeting customer demand, and ensuring operational efficiency. A. Just-in-time (JIT) inventory. Method: inventory is ordered and received only when needed in the production process or for fulfilling orders. Benefit: reduces holding costs and minimizes waste. Risk: if demand forecasts are incorrect, stockouts may occur. B. Economic order quantity, EOQ. Method: a mathematical model used to determine the optimal order quantity that minimizes total inventory costs, holding, ordering, and stockout costs. Formula: EOQ equals SQRT, 2DS/H. Where D equals demand, units. S equals ordering cost per order. H equals holding cost per unit per year. C. Safety stock. Method: extra inventory kept on hand to prevent stockouts due to unexpected demand or supply chain disruptions. D. Reorder point. Formula: reorder point equals lead time demand plus safety stock. This ensures the company orders more inventory before completely running out. 3. Financial reporting and accounting for inventory. Inventory is a critical asset and is reported on both the balance sheet and income statement. A. Balance sheet. Inventory as a current asset. It is reported at cost or net realizable value, whichever is lower, under current assets on the balance sheet. Net realizable value, NRV. The estimated selling price in the ordinary course of business, minus costs to complete and sell. B. Income statement. Cost of goods sold, COGS. When inventory is sold, its cost is transferred from the balance sheet to the income statement as COGS. Gross profit. Gross profit equals revenue minus COGS gross. Profit equals revenue minus COGS. Inventory valuation affects COGS, which in turn affects gross profit and taxable income. C. Inventory write-downs. If inventory is deemed obsolete or damaged, a write-down may be required to reduce its value on the balance sheet. This is recorded as an expense in the income statement. 4. Inventory turnover ratio. The inventory turnover ratio measures how efficiently a company is managing its inventory. Formula. Inventory turnover ratio equals COGS divided by average inventory. Where COGS, the cost of goods sold during a period. Average inventory. The average inventory held over the same period, calculated as average inventory equals beginning inventory plus ending inventory, divided by 2. Interpretation. High inventory turnover indicates efficient inventory management, but it could also signal that the company might not have enough inventory to meet customer demand. Low inventory turnover may indicate overstocking, poor sales, or inventory obsolescence. 5. Inventory accounting systems. There are 2 primary systems used to track and record inventory. A. Perpetual inventory system. Real-time updates. Inventory levels and costs are updated continuously as sales and purchases occur. Benefits: more accurate and up-to-date records. Usage. Common in modern businesses with automated systems and point-of-sale (POS) technologies. B. Periodic inventory system. Periodic updates. Inventory and COGS are updated at the end of an accounting period based on a physical inventory count. Benefit. Simpler but less accurate, relies on periodic counting. 6. Examples of inventory classifications. Manufacturing companies maintain raw materials, work in progress, and finished goods inventories. Retailers typically hold only finished goods ready for sale. To quickly recap, we've covered: mention the key points, for example, the different types of inventory, how inventory valuation impacts your financial statements, and strategies for effective inventory management. Understanding these concepts is essential for why it's important, for example, making informed financial decisions or running a successful business. If you found this video helpful, make sure to hit the like button and subscribe for more valuable content on related topics like finance, accounting, etc. And don't forget to leave a comment if you have any questions or thoughts. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.
Accounts payable and accounts receivable are key components of a company's financial operations. Accounts payable represents the amounts a company owes to suppliers for goods and services purchased on credit. These are short-term obligations reflected as liabilities on the company's balance sheet. For example, if a business buys office supplies from a vendor and agrees to pay in 30 days, the amount due will be recorded as accounts payable until it is settled. This indicates the company's obligation to pay debts to its creditors or suppliers. Conversely, accounts receivable refers to the amounts a company is owed by its customers for goods or services delivered on credit. These are considered current assets on the balance sheet. For instance, when a company sells products to a customer on credit, the amount due is recorded as accounts receivable until payment is received. This reflects the revenue the company expects to receive in the near future. Essentially, accounts payable is about money going out, while accounts receivable is about money coming in. Efficient management of both is critical for maintaining healthy cash flow within a business. By ensuring timely payments for accounts payable and collecting payments for accounts receivable, companies can manage their working capital more effectively and avoid cash shortages. Understanding AP and AR in accounting and the accounting treatment between IFRS and GAAP. Under both International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, the treatment of AP and AR follows similar underlying principles with slight variations in detail and presentation. Accounts payable represents the amount a company owes to its suppliers and creditors for goods and services received. These are considered current liabilities on the balance sheet, typically due within a short period, usually under a year. In IFRS, AP is recognized at its nominal value unless a discount is applied for early settlement, in which case the effective interest method is used. Similarly, GAAP requires AP to be recorded at the invoice amount, with adjustments for any discounts or credits received. Both standards emphasize the importance of timely and accurate recognition to reflect true financial standing. Accounts receivable, on the other hand, signifies the amount owed to a company by its customers for goods and services delivered on credit. This is presented as a current asset on the balance sheet. Under IFRS, AR is measured initially at the transaction price and subsequently at amortized cost, using the effective interest method, if applicable. An allowance for credit losses is also recognized, following the expected credit loss, ECL, model, ensuring a realistic valuation. GAAP uses a similar approach where AR is recorded at the invoiced amount, and an allowance for doubtful accounts is established, often calculated based on historical data and foreseeable risks. The main distinction lies in the methodology for estimating credit losses, with GAAP traditionally being more conservative. Both IFRS and GAAP aim to provide a clear representation of a company's financial obligations and entitlements. While the foundational principles are consistent, the specific criteria and methodologies for recognition, measurement, and presentation can vary, reflecting the slight differences in the frameworks. Understanding these nuances is crucial for accurate financial reporting and analysis. In the dynamic landscape of modern business, there are increasingly diverse operational models. Among them, some companies chose not to have accounts receivable, AR, or accounts payable, AP, as part of their financial structure. This might seem surprising for traditional business models where AR and AP play critical roles in managing cash flow, customer relationships, and vendor interactions. However, businesses adopting a zero AR/AP model generally operate on a cash basis, either receiving immediate payment for their services or products upon delivery and paying suppliers and vendors upfront. This approach allows these companies to maintain a cleaner balance sheet, reduce risks related to credit and debt collections, and improve their cash flow management. Many small businesses, particularly those in the service sector or direct-to-consumer retail, have found this model conducive to their operations. Instead of chasing down overdue payments or managing extensive payables, they streamline their processes for efficiency. Additionally, the advent of digital payment systems and e-commerce platforms has enabled these companies to operate smoothly without traditional AR and AP, leveraging technology for instant transactions. While this zero AR/AP model might not be suitable for every business, it highlights the importance of flexibility and innovation in financial strategies to align with specific business goals and market conditions. By eliminating the complexities associated with credit terms and invoicing, these companies can focus more on growth, customer satisfaction, and strategic investments, proving that traditional business processes can indeed evolve to meet modern economic demands.
Are you tired of making the same mistakes in trading? Or maybe you're just starting out and wondering how the pros consistently stay ahead in the markets? Whether you're a beginner or an experienced trader, the key to success isn't just luck, it's skill, strategy, and discipline. In this video, we're breaking down the exact steps that will take your trading skills to the next level. From mastering technical analysis to controlling emotions, we're covering it all. Ready to transform your trading game and make smarter moves? Let's dive in. 1. Study the market and strategies. 1. Technical analysis. This involves studying price charts and using indicators like moving averages, RSI, relative strength index, MACD, moving average convergence divergence, Fibonacci retracement, etc., to forecast price movements. 1. Books like Technical Analysis of the Financial Markets by John Murphy are invaluable. 2. Fundamental analysis. This focuses on the economic and financial factors influencing an asset's price. 2. For stocks, this includes analyzing financial statements, income statements, balance sheets, etc., and economic factors like interest rates, inflation, and employment data. 3. Understand different markets. Study how various markets like stocks, forex, crypto, and commodities behave, as they can be influenced by different factors such as geopolitical events or global economic indicators. 2. Practice with a demo account. 1. Benefits. A demo account simulates real market conditions without the risk of losing money. 1. It helps you become familiar with your trading platform, test strategies, and build confidence. 2. How to use it. Practice different strategies. Learn how to place orders, market orders, limit orders, stop loss, and refine your trading plan before moving to live trading. 2. Make sure to treat it like a real account to simulate actual trading conditions. 3. Develop a trading plan. 1. Components of a good plan. Your trading plan should include market to trade, stocks, forex, crypto, etc. Trading strategy. The criteria you use for buying and selling, e.g., breakouts, moving averages. Risk management. Define how much capital you are willing to risk per trade. Trade management. Plan your entry and exit points, including take-profit levels and stop-loss orders. Psychological discipline. Stick to your plan even when emotions come into play. 2. Why it matters. A structured plan helps you avoid impulsive decisions and stay consistent with your strategy. 4. Risk management. 1. Position sizing. Don't risk more than 1–2% of your trading capital on a single trade. 1. This ensures that even a series of losses won't deplete your account. 2. Use stop-loss orders. Automatically close losing trades when they hit a certain price. 2. This protects you from large losses. 3. Diversification. Don't put all your capital into one trade or one market. 3. Spread your risk across different assets or sectors to reduce exposure to a single event. 4. Risk-reward ratio. Aim for trades where the potential reward is at least twice the risk, 2:1 ratio. 4. For example, if you risk losing $100, the potential profit should be at least $200. 5. Keep a trading journal. 1. What to record. Document each trade's entry and exit points. Reason for taking the trade, outcome, profit or loss. Emotions felt during the trade, lessons learned. 2. Benefits. Over time, a trading journal helps you analyze your trading patterns, avoid repeated mistakes, and refine your strategies. 2. It also builds discipline and accountability. 6. Specialize in a few markets. 1. Mastery. Specializing in a specific asset class or market, e.g., forex, commodities, or stocks, allows you to develop deeper insights. 1. Each market has its own nuances and factors that influence price movements, so focusing on one or two markets helps you become more proficient. 2. Market hours. Different markets have specific hours that are best for trading. 2. For example, the Forex market is open 24 hours, but the best trading opportunities are during peak hours when liquidity is high, such as the overlap of the London and New York sessions. 7. Backtesting. 1. What it is. Backtesting involves applying your trading strategy to historical market data to see how it would have performed. 1. It helps identify weaknesses in your approach and gives you confidence in your strategy before using real money. 2. Tools for backtesting. Platforms like MetaTrader, Thinkorswim, or TradingView allow you to backtest strategies on historical data. 2. Ensure the backtest period includes both bullish and bearish market conditions for comprehensive results. 3. Limitations. Backtesting shows past performance, but market conditions can change. 3. Use it as a guide but continue adapting your strategy as new data emerges. 8. Control emotions. 1. Emotional traps. Fear can make you exit trades too early or avoid taking trades altogether. Greed can make you hold onto a trade too long, hoping for more profits, which often leads to losses. Revenge trading. After a loss, you may try to recoup it quickly by entering risky trades without proper analysis. 2. Mindset training. Practice mindfulness, deep breathing exercises, or even maintain a trading mantra to help keep emotions in check. 2. Some traders use automated strategies to remove emotional decision-making from the process. 3. Take breaks. If you've had a streak of losses or emotional trading, take a break to clear your mind before resuming. 9. Continuous learning. 1. Market evolution. Markets are dynamic, and new tools, strategies, and regulations are constantly emerging. 1. Stay informed by reading trading books, attending webinars, and participating in courses on trading platforms. 2. Follow experts. Engage with traders who have more experience. 2. You can follow trading mentors on YouTube or social media platforms for insights and strategies. 3. Improve strategies. Don't be afraid to tweak your strategy as you gather more data on what works and what doesn't. 3. Even the most seasoned traders continuously refine their approaches. 10. Join trading communities. 1. Why join? Networking with other traders allows you to share insights, discuss strategies, and gain feedback on your trades. 1. These communities can also be a source of moral support, especially during challenging times. 2. Where to find them? Platforms like Reddit's r/Daytrading or r/Forex, StockTwits, and Discord channels host active trading communities. 2. Be cautious, though, while these spaces can provide valuable insights, always cross-check advice with your own research. These detailed steps will not only enhance your trading skills but also help build the mindset of a disciplined, educated, and resilient trader. And there you have it, the tools and strategies to sharpen your trading skills and take control of your financial future. Remember, trading isn't about winning every time. It's about learning, adapting, and consistently improving. Success in the markets is a journey, not a race.
Accounting standards play a crucial role in how financial information is reported and understood globally. Two predominant frameworks govern these standards: the International Financial Reporting Standards, IFRS, and the Generally Accepted Accounting Principles, GAAP. Although both aim to ensure transparency and consistency in financial reporting, they differ significantly in various aspects. One primary difference lies in their foundational principles. IFRS is principle-based, which provides broader guidelines and requires interpretation, allowing for more flexibility. In contrast, GAAP is rule-based, with specific rules and criteria for various accounting scenarios, leading to less flexibility but more consistency. Another critical distinction is in inventory accounting. While IFRS permits only the use of the first in, first out, FIFO, and weighted average cost methods, GAAP also allows the last in, first out, LIFO, method. This can result in different inventory valuations and cost of goods sold, affecting a company's financial statements. Revenue recognition is another area where these frameworks diverge. IFRS adopts a single, principle-based five-step model to determine when revenue should be recognized, applicable across various industries.
Mergers and acquisitions, M&A, are strategic moves in the business world where either two companies combine their operations into a single entity, merger, or one company purchases another, acquisition. These activities are primarily driven by motives such as growth, market expansion, or diversification. From an accounting perspective, M&A transactions are complex and require meticulous attention to standards and regulations. There are several key areas to focus on when examining M&A accounting. The most commonly used accounting method for M&A is the purchase method. In this method, the acquiring company records the purchase of the target company's assets and liabilities at their fair market value. Historically, the pooling of interest method was also used, which allowed the combination of companies without recognizing any new goodwill. However, this method has been deprecated in favor of the purchase method under both IFRS and GAAP standards. Goodwill is a significant factor in M&A accounting. It arises when the purchase price exceeds the fair value of the net identifiable assets acquired. This intangible asset reflects the excess value paid, often due to brand reputation, customer relationships, or employee expertise. Goodwill must be tested annually for impairment to ensure it does not overstate the company's value. Intangible assets such as patents, trademarks, or customer relationships, which may not have been recorded previously on the acquired company's balance sheet, also need to be recognized and valued. One of the critical steps during an M&A transaction is fair value measurement. This involves determining the fair value of all acquired assets and liabilities as of the acquisition date. Following this, the purchase price allocation, PPA, process assigns the purchase price to these identified assets and liabilities, ensuring they are accurately reflected in the acquiring company's financial statements. Post-merger or acquisition, the financial statements of the acquired company must be consolidated with those of the acquirer. This means combining income statements, balance sheets, and cash flow statements into a single set of financial statements. Also eliminating any intercompany transactions to prevent double counting. Contingent consideration, often referred to as earn-outs, is part of the purchase price that depends on the future performance of the acquired company. This consideration is recorded as a liability or equity, and any changes in its value must be recognized in the income statement, impacting earnings. M&A transactions often lead to complex tax situations, especially concerning deferred taxes. These arise due to differences between book values and tax values of acquired assets and liabilities. Additionally, the tax treatment of goodwill can differ from its accounting treatment, potentially creating deferred tax assets or liabilities. Annual impairment testing is another key aspect, particularly for goodwill. If the fair value of a reporting unit falls below its carrying amount, an impairment loss must be recognized, affecting the income statement. Acquisition-related costs, including legal, advisory, and transaction fees, must be expensed in the period incurred and cannot be capitalized as part of the purchase price. Finally, future payments based on performance milestones, known as earn-outs and contingent liabilities, must be recorded as liabilities and remeasured each period, affecting earnings. Mergers and acquisitions, M&A, are complex processes that present numerous challenges for companies. One significant difficulty is cultural integration. This can occur due to differences in corporate cultures between merging entities, including varied management styles, values, and work ethics, which may lead to misunderstandings and conflict. Additionally, employees might resist changes brought by the merger or acquisition, especially in cases of layoffs or restructuring, further complicating the integration process. Valuation challenges are also prevalent as acquiring companies often overestimate projections, resulting in overvaluation of targets and subsequent financial strain post-acquisition. Assessing intangible assets such as intellectual property, brand reputation, or customer relationships is equally subjective and difficult, leading to potential mismatches in perceived versus actual value. Regulatory and legal hurdles can impede M&A processes. Regulatory bodies may block or impose conditions on deals if they deem the merger to reduce market competition and antitrust issues. International deals face extra layers of complexity due to differing legal environments, tax laws, and labor laws across countries, which can result in costly and time-consuming regulatory navigation. Integrating systems and processes is another major hurdle. Companies often face obstacles in merging different IT systems, which can be intricate and expensive. Additionally, harmonizing operational processes and workflows can slow down business operations and negatively impact productivity. Financial risks associated with M&A are also notable. Companies often overestimate the synergies, such as cost savings or revenue growth, which the deal is anticipated to achieve, leading to missed financial targets. Moreover, acquisitions often involve significant debt or substantial use of cash, which can create liquidity issues if the expected returns are not realized. Retaining key talent during M&A is crucial but challenging. Key employees, particularly from the acquired company, might leave due to uncertainty, loss of control, or cultural differences, leading to a loss of valuable expertise. Additionally, the departure of senior executives can result in instability and lack of direction for the merged entity. Effective communication and transparency are vital in the M&A process. Inadequate communication with employees, customers, and stakeholders can generate confusion, rumors, and reduce morale. Poor management of stakeholder expectations may lead to dissatisfaction and loss of trust, further complicating the merger. Integration of products and services is another critical area. Merging companies may face the issue of product line duplication, which can create market confusion and necessitate restructuring. Poorly managed integrations may disrupt service delivery, causing customer dissatisfaction and potential loss of business. Mergers and acquisitions, M&A, are complex processes driven by various critical aspects that ensure the success and smooth transition of the companies involved. One such vital aspect is due diligence, where the acquiring company conducts an in-depth investigation of the target company's financials, operations, legal matters, and other significant areas. This investigation can be categorized into financial, operational, legal, and tax due diligence, all of which help in assessing the true value of the target company and uncovering any hidden liabilities or risks. Another important aspect is deal structuring, which involves deciding between stock and asset deals. In a stock deal, the buyer acquires all shares of the target company, including its assets and liabilities, whereas in an asset deal, specific assets and sometimes liabilities are purchased, potentially reducing risk. Additionally, payment methods can vary. Common structures include cash transactions, stock swaps, or a combination thereof. Stock-for-stock deals are particularly typical when companies aim to conserve cash or leverage the buyer's valuable stock. Financing the deal can involve significant debt, known as leverage buyouts, or equity financing, where new equity is issued or existing stock is employed as currency. Financial risk is introduced especially if the acquired company does not generate enough cash flow to service the debt. Strategic buyers, usually industry-related companies seeking synergies, market expansion, or competition elimination, differ from financial buyers such as private equity firms, which focus on short to medium-term returns by improving and reselling companies. Hostile takeovers represent a more aggressive approach where the acquiring company attempts to purchase the target without board approval by directly approaching shareholders or attempting to replace the board. Defense mechanisms against such takeovers include poison pills, golden parachutes, and white knight strategies. Synergies, both cost and revenue-related, are critical as they enable reducing operating costs and increasing combined revenue through various strategies such as cross-selling or entering new markets. Employee and stakeholder communication is paramount during the M&A process to ensure trust and a seamless transition. Offering retention bonuses can help in retaining key employees throughout the transition. Post-merger integration, PMI, is arguably the most crucial aspect, requiring meticulous planning to align business processes, technology, teams, and company cultures. Integration issues often lead to inefficiencies and missed synergy opportunities, underscoring the need for a dedicated integration team. Breakup fees serve as a penalty if the deal fails due to reasons such as the target company accepting a better offer or failing to gain shareholder approval. Finally, anticipating market reactions is essential, as the announcement of an M&A deal can significantly impact the stock prices of both companies involved. Competitor response can also influence the market dynamics, as they may launch their own acquisitions or strategic adjustments.
Valuing companies is both an art and a science. Different sectors require different approaches depending on the unique financial structures, assets, and market positions. In this video, we'll dive deep into the most effective company valuation methods tailored to various industries like technology, construction, telecommunications, and more. Whether you're a business enthusiast, a financial expert, or just curious, you'll gain insights into how companies across different fields are assessed. Let's get started. Company valuation is the process of estimating a company's market value using a range of financial methods and analyses. Valuation methods vary based on factors like the type of company, its stage of development, and the sector in which it operates. Below are the most important company valuation methods, along with explanations for each. 1. Discounted cash flow, DCF, method concept. This method is based on estimating the future cash flows that the company can generate and then discounting them to their present value using a discount rate. Application. Determine expected cash flows over a specific period, 5-10 years. Estimate the terminal value after this period. Choose an appropriate discount rate, usually based on the company's cost of capital. Calculate the present value of the future cash flows. Advantages. Provides an accurate picture based on expected future financial performance. Disadvantages. Relies on future assumptions, making it susceptible to uncertainty. 2. Market multiples method concept. This method compares the company with similar companies in the same sector based on financial multiples such as the price to earnings, P/E, ratio, or the price to sales, P/S, ratio. Application. Select a group of comparable companies in the industry or market. Calculate the average multiples for each company, such as P/E or P/S. Apply these multiples to the company being evaluated using its financial data. Advantages. Quick and easy to use, especially when comparable data is available. Disadvantages. Depends on the availability of similar companies for comparison and may be inaccurate if companies differ in financial structure. 3. Net asset value, NAV, method concept. This method focuses on determining the net value of the company's assets after deducting its liabilities. Application. Aggregate the value of all assets owned by the company, land, buildings, equipment, etc. Deduct debts and liabilities from the value of the assets to obtain the net value. Advantages. Useful for companies with substantial tangible assets like real estate or industrial firms. Disadvantages. Does not consider the company's potential to generate future profits and may not be suitable for companies relying on intangible assets like technology. 4. Comparable transactions method concept. This method compares the company being evaluated to similar acquisition transactions that have occurred in the market. Application. Search for recent acquisition deals for companies in the same sector or of similar size. Compare the price paid in those deals with the financial data of the target company. Advantages. Reflects actual market values based on real transactions. Disadvantages. Difficult to apply if no similar recent transactions are available, or if the conditions surrounding the deals differ from the current situation. 5. Residual income method concept. This method is based on determining the profits that exceed the minimum required return on invested capital. Application. Calculate the net income the company can achieve. Deduct the cost of capital required to generate these profits. The remaining value represents the excess profits that can be used to evaluate the company. Advantages. Takes into account the cost of capital and actual profitability. Disadvantages. can be somewhat complex to apply and requires accurate assumptions. 6. Market capitalization method concept. This method is used to evaluate publicly traded companies by multiplying the stock price by the number of outstanding shares. Application. Determine the current stock price. Calculate the market capitalization by multiplying the stock price by the number of outstanding shares. Advantages. Easy to apply and reflects the price agreed upon by the market. Disadvantages. Only reflects the current stock price and not the intrinsic value of the company. Best valuation methods by sector. 1. Digital, tech companies best method. Discounted cash flow, DCF, why? Tech companies often rely on strong, scalable future cash flows. Since tangible assets are usually minimal, the focus is on future financial performance. Example, a company like Apple or Google is valued by projecting future cash flows driven by innovations, expansion in services, and product development. Alternative method. Market multiples use revenue or earnings multiples to compare tech companies like Tesla or Meta with industry peers. 2. Construction companies best method. Net asset value, NAV, why? Construction companies rely heavily on physical assets like land, buildings, and heavy equipment, making asset-based valuation fundamental. Example, companies like Bechtel or Vinci Construction can be valued by estimating the current value of the tangible assets and subtracting their liabilities. Alternative method. Market multiples compare construction companies using earnings or revenue multiples within the industry. 3. Telecommunications companies best method. Discounted cash flow, DCF, why? Telecom companies generate steady, long-term cash flows from subscriptions and network expansions, making DCF an ideal method. Example, companies like Verizon or Vodafone are valued based on cash flows from their subscriber base and digital services, discounted to present value. Alternative method. Comparable transactions use recent industry transactions, such as a telecom company acquisition, to gauge market value. 4. Manufacturing companies best method. Market multiples why? Manufacturing companies often use earnings or revenue multiples due to fixed costs and margins that depend on production efficiency and operational costs. Example, companies like Ford or General Motors can be valued using earnings multiples compared to peers in the same sector. Alternative method. Net asset value, NAV. Manufacturing companies also have significant physical assets, factories, equipment, that can be valued through an asset-based approach. 5. Retail companies best method. Market multiples why? Retail companies often rely on revenue or earnings multiples due to fluctuating sales and changes in supply and demand. Example, companies like Walmart or Target are valued based on revenue multiples compared to other retail companies. Alternative method. Discounted cash flow, DCF. If the company has a large customer base and stable cash flows, DCF can be used to estimate long-term value. 6. Energy and oil companies best method. Net asset value, NAV, why? Energy companies rely on physical assets such as oil fields and refineries, making asset valuation critical. Example, companies like ExxonMobil or BP can be valued based on the net value of their tangible assets. Alternative method. Discounted cash flow, DCF. DCF can also be applied if the company has long-term cash flows from exploration or renewable energy projects. 7. Fintech companies best method. Discounted cash flow, DCF, why? Fintech companies often rely on rapid growth and future cash flows, making DCF the best approach. Example, companies like PayPal or Square can be valued based on future cash flows from transactions and financial services. Alternative method. Market multiples use revenue multiples or active user base to compare fintech companies with similar peers. Now that we've explored the key methods of company valuation, each with its unique approach and applicability, it's clear that no single method fits all scenarios. By understanding these techniques, you can better assess the true value of a company, whether you're an investor, a business owner, or just someone interested in financial analysis.
The time value of money, TVM, is a fundamental financial concept that asserts money available today is worth more than the same amount in the future due to its earning potential over time. This concept is anchored around the idea that money can earn interest, meaning that any amount of money is worth more the sooner it is received. Imagine you have an option between receiving $100 today or 1 year from now. If you take the $100 now, you can invest it and earn interest, ultimately having more than $100 in a year. This underlying principle is why TVM is crucial for both personal finance and business investment decisions. In calculating TVM, several key components come into play: present value, PV, future value, FV, interest rate, R, the number of periods, and sometimes payment, PMT, when dealing with annuities. The period can refer to anything from years to months, depending on the context. The formulas central to TVM calculations are FV equals PV asterisk open parenthesis 1 plus or close parenthesis to the power of N, which calculates what an investment made today will be worth in the future, and PV equals FV slash open parenthesis 1 plus or close parenthesis to the power of N, which calculates what a future amount of money is worth today. Another essential consideration is the interest rate, which can be simple or compound. Simple interest is calculated only on the principal amount, while compound interest is calculated on the principal amount and also on any accumulated interest. Compounding can occur annually, semi-annually, quarterly, monthly, or even daily, significantly affecting the total amount of interest earned over time. For instance, consider an investment of $1,000 with an annual interest rate of 5%. If this interest is compounded annually, after 1 year, the investment will be worth $1,050. However, if compounded monthly, the investment will grow slightly faster, illustrating the power of compounding. Understanding TVM is essential for making informed financial decisions, whether one is planning for retirement, considering a mortgage, evaluating investment opportunities, or managing personal savings. It helps in comparing investment options, assessing the value of future cash flows, and ultimately ensuring that one's financial resources are allocated in a way that maximizes wealth. By appreciating the time value of money, one can better navigate financial planning and investment strategies to achieve long-term financial goals. Time value of money, TVM, is a financial principle that states the value of money changes over time due to its potential to earn returns or appreciate. TVM usage can be seen in several financial aspects. Investment analysis. TVM helps in comparing the value of money today with its value in the future due to potential returns. For example, it aids in determining whether to invest in a project by comparing the present value of expected returns to the initial investment. Loans and mortgages. TVM is used to calculate the present and future value of payments for loans and mortgages. It helps in determining how much will be paid in interest and the overall cost of borrowing over time. Retirement planning. TVM is utilized to estimate how much money needs to be saved and invested now to achieve a desired amount in the future for retirement. This includes factoring in interest rates, inflation, and other variables. Bonds and securities pricing. TVM is crucial in determining the price of bonds and other fixed-income securities by calculating the present value of future interest payments and the principal repayment. Savings and investment planning. TVM helps individuals in deciding how much to save and where to invest by comparing different saving and investment options and their future values. Capital budgeting. Companies use TVM in capital budgeting to evaluate the profitability of projects by comparing the present value of cash flows generated by the project to the cost of the investment. Understanding TVM allows individuals and businesses to make better financial decisions by taking into account the impact of time on money, ensuring that investments, savings, and expenditures are optimized for maximum return and minimum cost.